the Gold Mine Podcast.
In terms of passive investors, right? So we're talking about LPs, when we're talking about people who are investing in your deals, what advice would you give to an LP who maybe is looking at an industrial, like a flex industrial deal? Like, what are the questions? What are the things that they should be asking before engaging with a sponsor?
Yeah, I mean, I think a big deal is looking at just kind of the overall trends of that submarket or market. Like, is there new industry coming into town? Is there established industry already there? Like, are you near a port? Like, what is the driver that has, because your tenant base is going to be a lot of like home services, right? So like, are there new homes coming into the area? Are there new industries like an AWS facility, and you're going to have a lot of contractors that need space? Like, what is the overall driver? Because like flex industrial is not really like the growth piece, right? Like the new AWS facility is the growth piece, but like you can be the supporting role by being in the flex, right? So like, what is the overall demand generator for that entire market, and how does flex play into that? Like, I think that's a big one. I would also look at that's probably the biggest one that I would look at. I'm trying to think what other questions I would ask. I would also look at the rent roll and trying to see like what kind of tenants are in there. It's good to have a mixture of some nationals as well as some mom and pops. The reason we look at that is because like a national like FedEx is a tenant of ours, or like a Terminex, or whatever the case might be, like an international company. Like, they'll go and close 50 facilities overnight. Like, that's just part of their business plan, right? Like, they have a lot of leases. That's what it is. And it's great to have those big blue chip credit tenants, but like that's the reality of having them. At the same time, you can have Bob's HVAC company, and Bob needs that office warehouse to be able to feed his family. And so even if markets get tough, like Bob's probably going to continue to operate because Bob has to fix HVACs and he has to have a place to work, right? And so we always kind of see that while it's not a huge credit tenant, the mom and pops are sometimes a little bit stronger and sticky of tenants because like they have to have that single location. FedEx does not have to have that single location. So that's another thing I would look at is like, do you have a good blend of credit tenants as well as your locals, so that kind of like build out a good mix throughout rather than being too weighted in either or?
Makes a lot of sense. Something that just popped into my head as you were saying that too, as a passive investor, what would a good Walt to hold period ratio be? Meaning like, if you're saying your whole period, let's just for ease, right? Like say 10 years, whole period is 10 years. What should the Walt be?
I mean, I would think you would want to be shorter Walt regardless. Like our typical deals are a 5-year deal. And so we want to see a Walt with say a year or two, so that you have enough time to kind of get established in the asset, start rolling tenants, and then say over years 1 and 2, cash flow is going to be less. You're doing your value add strategy, but then starting year 3, you should have really good established cash flows. So you have good distributions for 3, 4, and 5, and then you sell it at a good appreciated value. So I feel like that timeline works really well. But even on a 10-year deal, I would still look for like 1 to 2 year walls. I don't think that you want to get into something where you're essentially buying something that while it might be great on a price per pound or price per square foot kind of theory, if you're sitting there almost zero cash flow for 4 or 5 years until you can roll that rent roll, I'd still probably would stay away from that. I think having that shorter term to be able to get them to market is really important. Now, granted, that is a double-edged sword, I will point out.
Right.
But you also have, say, 70% of your rent roll rolling within a year. If none of them renew, you really need to be able to make sure that you're reserving a lot of money to make sure that you can carry it through that re-tenanting process if it goes that direction. So you need to know your client base and your market, but also realize that like having a great wall to be able to mark to market's great, but also you can have a lot of vacancy.
That makes a lot of sense, right? So you want to make sure that you have a strategy, if and when those tenants don't renew their lease. And in regards to the Walt, one thing that I wanted clarity on is like if there's no tenant inside that space, does that count as a zero, or does that count, or like, are you not including that in the Walt?
Yeah, you're not really including that in the Walt. You're really including like your in place.
Okay, gotcha. So we want correct, Walt under like, under 2-ish years or so, so that we have enough time to kind of like have the new rent add value to the property, right?
Yeah.
If there's a building where you suspect, for example, because like in hotels, right? Like occupancy is a big thing. And so when we see a hotel was like, hey, it's being mismanaged, occupancy is like well below where we know the comp set is at. And so are there similar metrics in flex industrial? Like, can you see, or do you know like what the average like occupancy is for buildings around the area? Yeah.
Yeah. I mean, it's not as detailed. So I assume that y'all use star reports still a lot. Is that what you're getting your comp set from? So you have similar data to a star report through CoStar or Crexi, kind of your traditional, platforms. They're not perfect. I mean, really the best way to look at it is to go on LoopNet and go on for lease and type in, like, say your facility has a lot of 2,500 to 5,000 square foot units, like search that size in your submarket. If every building has 2 or 3 availabilities, you probably have an occupancy problem. I don't really know if you've seen that in too many markets, just because most of our occupancies are really high. But like that's really the best way. Is like, is there a ton of that space sitting on the market? And then talk to those brokers, see how long it's been on the market. It might be one of those things where it's like, oh yeah, we have 4 spaces on the market, but they all rolled last month and we're going to have to sign 2 leases. So it might not be a big deal. But if you start talking to a lot of brokers, like, yeah, we've had 3 vacancies for a year, that is an issue that you need to watch out for sure.
Yeah, I definitely, I see that as a potential. Like for us, it's so easy because like everyone basically has to report to Star, right?
Yeah,
or
exactly.
They don't have to, but like most of them do, right? So,
which I never realized how like rare that was. Like I was always in the hotel brokerage business, so I just figured that was all. And then you start looking at other asset classes, like especially self-storage, and like you can't figure out other people's occupancy really that efficiently as you can in hotels and really any other asset class. It's a beautiful thing that hotels do that.
It really is, man. It really is. So I was, I'm curious how you guys go about doing it. So sounds like you got to do a little bit of sleuthing and
you do.
And making some phone calls and whatnot. And that makes sense to me. So, okay. And that, I think in terms of a passive investor, though, it sounds like those are really the things that they want to focus on, right? Like the market, making sure that they're comfortable with that, making sure that they're comfortable with, like the Walt and whatnot. So that makes a lot of sense to me.